Morning, everyone, and welcome to the late October edition of CapWealth On. I'm Tim Pagliara, Chairman and Chief Investment Officer of CapWealth, and joining me this morning is Grant Stark. Grant is our Director of Research and on our executive team. So welcome, Grant. This morning, we're going to, in 5 minutes or less, we're going to take on the really tough subject of the returns in the market this year. And, I want to start by saying we became very defensive and started investing very defensively when the pandemic hit. And we've been preparing for that, the ultimate consequences of the pandemic since the spring of 2020. And we had no idea that the Federal Reserve was going to print $10 trillion worth of money and create the level of economic stimulus that we have today. That's led to inflation. We could see all that coming. We got very defensive at the first part of 2023. We have almost 20% of our asset base now in short-term U.S. Treasury bills that we roll every quarter, and a number of other non-correlating assets that will protect assets, but they certainly won't compete with the returns of the Magnificent Seven like we've had this year. So let me turn it over to you, Grant, and now we can speak about some of the details, some of the mechanics of why we've had these extraordinary returns that seem to be evaporating right now in the Magnificent Seven, how we're positioned, and what clients can expect in terms of the volatility in their account. We said we're going to protect them. Let's show them how we're doing it.
Sure. Well, thanks, Tim. And for everybody listening, nice to meet you on the video, and thanks for being a valued client. One of the things that we really focus on is what Tim had pioneered called sophisticated simplicity. And that's taking these really complex items and trying to boil it down to something that we can understand, that we can articulate to you, and that we can visualize. And so, as Tim mentioned, we're going through a very challenging time in the economy with higher interest rates, a changing of the guard, if you will, on Fed policy and monetary policy in general. And this gives us an opportunity to show you some of those details on the performance side and what has informed our allocations going forward. So the first chart I want to show you is a chart of the Magnificent Seven versus the S&P 500 and the NASDAQ. And just for everyone's knowledge, the Magnificent Seven is comprised of Apple, Amazon, Google, Facebook, which is Meta, Microsoft, NVIDIA, and Tesla. And those seven, since the beginning of the year, or in fact, if we actually go back to December of 2022, all the way through the 20th of October, we see that those Magnificent Seven, just those, are up 86%. And if you exclude those seven from the rest of the market, the S&P 500 is only up 0.4%, and the NASDAQ is only up about 5%. And so when we take this into context, the next chart I want to show you is just a bar chart of the same performance. And what that shows us is that Meta and NVIDIA are actually driving most of that outperformance. And what that tells me is that if you wanted to beat or meet this market right now, you'd have to be a fairly irresponsible allocator of capital to have concentrated into just seven names. In fact, the NASDAQ right now is about 50% weighted in just those seven companies. And so when we take that as a first picture, we say, gosh, there's a lot of concentration risk just in these companies.
That's a really interesting point. And just to reinforce it, what you just said was if we were going to replicate the performance that's out there today, we would have to invest our clients' money in only seven different companies.
That's right. And it actually...
That's irresponsible.
That is irresponsible. And if we look back, we wanted to consider also companies that are not comprised of the Magnificent Seven, but companies we have reviewed in the past as potential investments. And that gets to the next chart. This is a chart from July of 2021 through October 23 of this year. And what that shows is Beyond Meat, Zoom, DocuSign, PayPal, and Moderna, they're all down between 80 and 90% since July of 2021. These were all companies at the time that people were screaming to purchase and wanted to hold on to. And it's just a cautionary tale that during that time, even the S&P is down in that time frame. It's down about 0.5%. So it's a very cautionary tale that not only the Magnificent Seven have risen, and you'd have to allocate so much of your portfolio into those seven, but if you get it wrong with certain names that had such high valuations where we steered away from them, and of course it's hard at the time when you have investors in the market saying this is where you need to buy. But we look further into that and we say these valuations are out of control, and sure, there are temporary mismatches in performance, but we want to work through those mismatches. And a good example of that is Raytheon. So most client accounts will own Raytheon or own it now. And Raytheon is a very good example that we have owned it for a long time. And we actually just added another wave to many client accounts. And there's a lot of noise in Raytheon right now because they had an engine issue with a part in some of their engines. But we see through that immediate market noise and know that long-term they are generating tremendous cash flow. We love management, and they will work through this engine issue. Plus, they are a defense contractor in an environment that needs defense contractors. So an example like that, Tim, is exactly where we want to steer the ship in allocations going forward.
And why don't we just take just a minute to kind of wrap up and fold in our belief about interest rates and how that's going to continue to impact this. Inflation's not under control. All the measurements that they have in the current indexes that they put in front of you don't include housing, they don't include food, and they don't include transportation. Wouldn't we all love to be able to live without having to spend money on those items? And when you fold those back in, inflation's still 4 to 6%. General Motors just signed a contract with an 11% increase in the first year, and then 25% increase over the next 4.5 years. Chairman Powell says any labor contract in excess of 2% that's not accompanied by a productivity gain, it's inflationary. So we're in the belief inflation's going to stay. Interest rates will stay higher for longer. And when I say longer, this may be the new norm. I'm not expecting rates to decline significantly going forward because of the strength of the economy. And that makes the valuation of some of these companies that don't have earnings and profits, don't have the dividend income, the caution that we have in mind, it makes it very almost uninvestable. As we bring this episode to a close, I just want to remind everybody we are more than welcome to get you on the phone, talk you through this, give you an understanding of how all of these issues that we talked about today relate to your account. And then, Grant, I think it would be a good idea for our next podcast to talk about the impact of this massive increase in rates, how it affects valuation, the great choices it's going to give investors, and the longer-term positive of having capital appropriately priced so that it works efficiently in our economic system.
That's right, Tim. And we'll work diligently to simplify some of this data for the next podcast. And in the interim, like Tim mentioned, I will just echo, we are here for you. And if anybody would like to dive into today's session further, please reach out to your advisor, and we are glad to discuss further. Thank you.
Thank you, everybody.